maybe we're in a new situation where consumers are essentially going on strike as relates to paying their debts. We have created a culture of moral hazard on Wall Street, but I think we're starting to see it on Main Street as well.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Greed and exuberance returned to Wall Street as we ended 2023 and welcomed the start of 2024. Markets are trading near all-time highs, the Fed has switched to singing a more dovish tune, and confidence in a soft landing, or even a no landing, for the economy is high. Did we manage to emerge from all the chaos and distortion of the past few years without a major reckoning? Have we dodged the bullet of recession? For answers, we're lucky to talk today with top Thoughtful Money fan favorite, Stephanie Pomboy, economic and financial analyst and publisher of the respected research firm Macro Mavens. Stephanie, it's wonderful to have you back on the program. Thanks so much for joining us today.
Thanks, Adam. Happy New Year.
Hey, same to you.
Congratulations. This is my debut on Thoughtful Money.
I know, and I got to tell you, Stephanie, not a day has gone by since I launched the program that I haven't been bombarded with questions of when is Stephanie coming on?
Oh, please.
Thank you so much for coming
gosh.
on and hopefully shielding me for at least a little while from that barrage. Well, look, lots to catch up on since we last talked. I am very interested to see if your macro outlook has changed at all since we last talked, which was back in, I think, October-ish, because as I just said in the intro, there's a lot of green shoots that a lot of people are pointing to, and I'm curious if you think those are real and outlook changing, or if maybe they're just providing some false signals right now. But before we get into the details of that, can we just start with my regular broad question I like to kick these discussions off with? What's your current assessment of the global economy and financial markets?
Well, I guess my answer to that question is going to get into the question of the green shoots and the shift in tone from the Fed, because as you know, throughout our discussions last year, I was just emphatic on the idea that the impact of the higher rates was going to be felt, and just because it hadn't happened yet didn't mean it wasn't going to happen. And everything I looked at in terms of the enormous leverage that had been built up since the global financial crisis, and then took off, really exploded after COVID, suggested that there was tremendous vulnerability to the increase in interest rates, and it was just a matter of time before that became evident. And in fact, we did see the largest number of corporate bankruptcies since the global financial crisis outside of COVID last year. And we've obviously seen a huge increase in consumer delinquencies as well, and commercial real estate, et cetera. And yet,
bank failures too.
And bank failures, exactly. And yet, when if you were a man from Mars coming down and looking at the financial markets at the end of 2023, you would have had zero inkling that all of these rate hikes had really taken place. I mean, credit spreads actually impossibly narrowed, even as all these delinquencies and defaults materialized. So, I was puzzling throughout the year as I watched this, enthusiasm for risk assets in the face of deteriorating credit quality as to how long this was going to be sustainable. And it seemed to me like people picking up, that proverbial picking up the nickels in front of the steamroller. And then, Powell made with his dovish talk after the last Fed conference. And I guess my takeaway from that was he's basically ratifying the market expectations.
Mm-hmm.
The markets all year refused to hear what the Fed was saying about higher for longer, and priced in rate cuts, and were therefore willing to continue to extend credit to struggling over-levered enterprises, because they assumed that those struggling over-levered enterprises would be made whole basically as the Fed cut rates and their debt service went back to what they perceived to be a more normal, manageable level. So, long story short, everyone was all in on this idea that the higher rates were a temporary phenomenon that would quickly reverse. So they all made that bet. Banks continued to lend, capital markets, flung the doors open. And so where I am now, there's a very long-winded way to answer your question about my macro view, is we're really in this kind of no man's land. I call it like a purgatory. We don't know really where we're going. We're in limbo because while the fundamentals are still, the backdrop is still incredibly negative. We still have all this leverage built up, from the government to corporate sectors to consumers, et cetera. And that debt is rolling at higher rates. However, if the markets and lenders are willing to be accommodative on the expectation that things are going to get better, that expectation has the power to create the reality.
There's a reflexivity there, yeah.
Right, just as we saw all of last year, even as corporate bankruptcies piled up, private credit, banks, everyone were willing to go out there and extend credit. So I'm now kind of have been schooled in the degree to which perception can become the reality. And so the struggle for me is that, yes, fundamentally, the backdrop is still incredibly negative. But if hope continues to spring eternal and the Fed does maintain this sort of more dovish posture and ultimately deliver on the rate hikes, maybe the
You mean rate
crisis.
cuts? Sorry.
I'm sorry, rate cuts, boy. Maybe the crisis will in fact be averted. I mean, my heart isn't in that thesis. I think that, it's still, I like to believe in the triumph of the fundamentals. And unfortunately, I've been waiting for that triumph for a long time, and it's not materialized. And I also, from the standpoint of actually finally cleansing the excesses that have been built up in our system for decades now, would really look forward to a credit bust and a deep recession that finally expunged all these excesses, and we could start fresh and start from a really good, solid, fundamental foundation. Much as I imagine that will happen, and that's still my main view, I've been humbled enormously over the last year by the power of expectation. So I'm really right now, as a cop-out, maybe sitting in cash on the sidelines, because again, you're still now getting 5% to wait and see how this fleshes out, and whether the Fed can deliver the rate cuts the market anticipates soon enough, which is crucial, and aggressively enough to really stave off a meaningful wave of bankruptcies on the corporate side and delinquencies on the consumer side. Boy, that was long-winded, and I don't know if it answered your question.
No, it provided exactly the context of wanting to know where you are right now. And I share a lot of your feeling. I'm sure a lot of our viewers do too. I want to dig into a couple of things around this, if we can. One, I want to talk about the role of liquidity, and how you've seen that impact the system here. I've talked to a number of people relatively recently who believe that has been a key factor here in kind of pushing off recession, supporting markets, juicing economic growth, basically keeping things better for longer, if you will, economically speaking. And I think there's maybe some differing views amongst that camp for how sustainable that liquidity wave will be. There's some like Michael Howe who thinks it's going to continue for the next 2 years, and that we're going to have great 2 years in the economy and the markets going forward. Other folks not quite as confident. I also talked to Wolf Richter, who I think you would probably find to be somewhat of a kindred spirit, where he basically said, look, we need a recession. right? He's like, I totally think we need one for a lot of the reasons you just mentioned. He said, but I'm looking at the data and I don't see it coming anytime soon. And I got to call it as I see it, right? So I'm curious, when you talk about us being in limbo right now, do you, are we in limbo and you just really don't know how it's going to end up right now, and so you're just still kind of casting around for clarity? Or is it limbo where we're kind of, sometimes markets can grind sideways for a long time before they start coming up again, so we're just kind of maybe it's this rolling recession that people talk about, where we're not going to really net fall into a recession economically, but parts of it will weaken, but overall we're just going to move sideways until things can continue moving higher? Or is this a kind of like an interim period where it's like eating your seed corn, in the wintertime, it's eating your seed corn or it's burning your furniture to stay warm, right? Like, when you're doing those two things, you're warm and fed, but you are basically ruining your future prospects. At some point, you've eaten the last of your seed corn, and then there's no food left, or you burn the last stick of furniture and you got nothing to sit on after that. In which of those three outcomes it feels more accurate to you right now?
Well, I guess the last one, to the extent that, let's say, for example, you had companies that had borrowed at 4% last year and during the, let's say, COVID stimulus extravaganza, when rates were, flat on the mat. And they had to roll that paper at 8% last year. And that became a little onerous. So in came private credit lenders who said, you know what, we'll take that paper off your, we'll lend to you at 6.5 or whatever the magic number was. That sustained them. So, but in the process, they're still massively levered. And unless their fundamental business model turns around, they're still in this situation. It's sort of like you're saying, with the seed corn, essentially, they bought themselves a little more time. They burned through a little more capital in the hope that everything's going to be better in the near future. So it's a monster bet. And what if the economy actually doesn't improve and we don't see that increase in earnings that everyone's anticipating? I think S&P earnings are still forecast to grow 12% or something this year.
Yeah.
So, and those numbers are starting to come down a little bit, but they're still, pie in the sky. So a lot of it will turn on that. I mean, the other thing that I'm trying to wrap my head around right now is, and leaves me even more uncertain and in my own mental limbo about where we're going, is this prospect that maybe we're in a new situation where consumers are essentially going on strike as relates to paying their debts. We have created a culture of moral hazard on Wall Street, but I think we're starting to see it on Main Street as well. And a couple things made me think about this as a theme, and that is, obviously, the student loan payments kicked back in October, but the non-payment rate, from what I've read, is very high. Like, a lot of students, former students who are trying to pay those debts, have concluded they kind of threw up their hands, and they're basically saying, I don't understand what I need to pay and when I need to pay. And they're basically just not making the payments.
Yeah.
There's also a stat on, we have a record federal income tax non-payment right now, which is amazing to me. I mean, it's one thing not to pay your student loan debts or your credit card debts or whatever, but to not pay your taxes. So it seems to me like we might be creating a cultural shift where consumers maybe, because Biden suggested he was going to forgive student loan debt, even though it was unconstitutional, and then continue to try to, push for it after the fact. Maybe people are thinking, hey, it's okay if I get in over my head on my credit card or my auto loan or whatever, because they'll forgive that next. So I mean, I'm not sure if this is happening, but I do see hints that maybe there is a little bit of this cultural shift taking place. And that's kind of terrifying,
Yeah,
when
it's such an interesting. I'm so glad you brought this up, because I think, I've touched upon elements of this over the past couple of years, on this channel and its predecessor, and you and I have even talked a little bit about this. Um, we homeowners, got bailed out, coming out of the 2007 housing crisis. Obviously, everybody famously knows how Wall Street's been bailed out.
Mhm.
We bailed out households during COVID, right? There's the direct checks to households. We had all these forbearance programs. I think you're right. I think it's understandable to question, have we built a culture of moral hazard here? And I just looked up the stat while you were talking there. 40% of people have not made payments on their student loans since they went back into repayment, right? So that's getting close to half, right? That's not an insignificant percentage, right? And so I don't think it's too large of a stretch, as you're presuming, where people would just say, well, wait a minute, if I don't have to really pay my student loan debt, why should I pay my
Right.
car payment if it's tough this month? Why should I pay my credit card company?
And also, as you and I have talked about, we're creating this kind of class warfare where if you didn't have student loan debt and that's being forgiven for your neighbor, you're saying, well, screw that. Maybe I won't pay my credit card debt. Like, why should they get away without paying debts? And I'm sitting here being responsible. So it may very well extend beyond the student loan thing and create this kind of cultural sense of I'm not
Absolutely. And,
responsible.
and that's the Pandora's box that intervention opens, right? Is when you start basically playing favorites to a certain extent, right? You're saying, okay, this class here, I'm going to give relief for whatever reason, and maybe it's well intentioned, but you unleash this sort of domino effect of people basically saying, well, why not me, right?
Right.
Um,
So
and
then the
where
question,
does this end? Does this
that's
end embracing MMT and just, hey,
well, that's the question is how, if that's true, and this is why I'm so much in this mental limbo right now. I mean, we've got in the corporate sector, the prospect of a real corporate credit bust, which I had been forecasting for a long time, being forestalled by this anticipation of lower rates and therefore banks and non-bank lenders just continuing to shovel money to sustain those enterprises. So we've got that on the one hand. And then on the consumer front, where you would think, well, they don't have access to private credit and capital markets or whatnot, they're going to get screwed as rates go up. And I mean, we've seen credit card borrowing explode into 23% credit card rates.
yeah,
It doesn't
all-time high APRs, yeah.
it doesn't make sense. Normally borrowing and interest rates don't really move together. When rates go up, people stop borrowing. It's like getting slapped on the wrist.
Right.
And it's been the opposite this time. So it does make you think that maybe people are saying, look, it doesn't matter how much I borrow, I'm never going to have to pay it back. And if that's the case, you continue to see defaults or delinquencies on the consumer credit side. So I guess the rubber meets the road when banks and these other lenders find they're not getting paid back, and then that it becomes a big enough problem that it's a systemic issue, at which point you can bet that the Fed or someone is going to come in with some kind of bailout. But in the interim, what it's doing is sustaining consumption in the face of what normally would have been a fundamental backdrop that would have seen consumer spending much weaker than it is now. I will argue, however, and you've heard me argue this many times before, that consumer spending, while it's held up well, is not nearly as good as it looks. First, because like when you look at retail sales, it's not deflated. So it's entirely, in fact, I think inflation is 3.1 and retail sales were up 3.1 year on year. So there's no growth in retail sales in real terms. And that actually has been the case since March of 2022, the months when the Fed started raising rates. So in essence, consumers aren't buying more stuff. They're just buying the same amount of stuff and paying
It's
more.
just
And
costing more, yeah.
yeah, it's an inflation illusion of strength, but in reality, they're not, buying more stuff. However, you would think they'd actually be buying less stuff because you're now seeing a slowdown in employment, and their debt service costs are back relative to income to the highest level since the global financial crisis. And so they have real pressures. At the same time, the basic bare necessities of life, while they're not going up as rapidly in price, are still at a very high price level.
Right. And way higher
Um,
than they were just 2 years ago. Yeah.
exactly. So you would think all those things would conspire to see them actually cutting back expenditure, and that hasn't happened yet. And perhaps it has something to do with this culture of non-repayment of debts.
All right. So I want to dig into that just a little bit more. I've got a bunch of questions about the economy and where you see things headed. So we'll get to those in a second. But this is just a really important vein, and I sense that we're going to talk about it more in the future. Um, you know, what's interesting culturally is we are when you look in aggregate, right? Is we I don't know the right way to say this, but like we see as like belt tightening as like a hardship that is beyond the pale, right? That no matter what happens, I still need to be able to afford my $1,000 smartphone and all my streaming subscriptions, and still got to take that vacation and all that type of stuff. And one thing that kind of made me reflect on this was I just saw the movie The Boys in the Boat.
Oh, I'm dying to see that.
Okay, so great story, Cinderella story, a Depression era men's crew team from University of Washington, because underdog player, made up largely of young men from Depression era families, where like literally the main character is rowing on the team because that's the only way he can get a dependable meal, right? But they end up beating all the Ivy League schools, and then they end up going to the Olympics in Germany that year. But the main character, and this is, I'm sure, the Hollywood manufactured drama, but his sort of wound is that his father left the family when he was 14 and kind of left him on his own, because the father had to go find work in California, right? And then this guy who's now in college bumps into his father in Washington, and is surprised his father's been actually back in town, hadn't reached out. And his father says, well, what do you want from me? And the guy says, well, look, Dad, I was 14 years old when you left and left me on my own. And the dad says, what do you want from me? When I was 14, I was sent to war. Right. And it's just a reminder of like, not that many generations ago, like life was really pretty tough for a lot of people. Right. And this is still in the 20th century. Right. Like you go back another century or two and talk to somebody who lived in Russia and, died by the millions or whatever. Right. Like we're at the point now where, like, again, having to consider giving up my smartphone is like just an unacceptable, beyond the pale sacrifice that of course nobody could ever make, and the government should step in and make sure that I'm bailed out so that I can continue to do all this stuff, right? You're just sort of nodding sadly as I'm saying this. But the reason why I kind of tell that story is to your point, like we are increasingly, I think, becoming a populace that says things hurt, give me relief, right? And I think we have, seems, an increasing amount of politicians, central planners who are willing to say, yes, I will do that for you. That's my job. And maybe it's, I'm doing it as well because I hope you'll vote for me next time around, right? And where does this end? That is obviously not sustainable. And we end up in a way worse position in the long term, I believe, because we've basically pulled tomorrow's prosperity into today, trying to pay for things that aren't affordable or sustainable. And that everybody is faced with fewer options than they otherwise would have when the end of the road arrives. Do you share the same concern?
Yeah, well, absolutely. And I think you are now bringing me to the one thing about which I have certainty in 2024, given everything I laid out at the top, being in this sort of economic limbo. The one thing that seems absolutely clear to me as we look at the federal debt hitting 34 trillion, that the dollar is going to pay the price for our monetary and fiscal policy sins big time this year. We're already seeing the dollar decline on the expectation that the Fed is going to pivot, really accelerated its decline after Powell's very dovish FOMC. And this is just the cyclical force driving the dollar lower. It's just based on Fed rate cuts. And the prospect, I would say that they are going to cut rates despite the economy not being in recession and the markets not being catastrophic.
Right.
So it's essentially going to be an immaculate rate cut or an immaculate easing cycle. To me, that is the most egregious monetary debauchery you could ever contemplate. And it seems nakedly political as we head into an election year, especially at a time when, as yet anyway, the inflation picture has not come anywhere near to where the Fed really wants it. I mean, sure, you can look at, 3 months rate of change of the super core or whatever, number you want to look at. But as we talked about earlier, the average guy on Main Street only knows that his cost of living went through the roof and is now getting slightly less, getting more usurious at a slightly less rapid pace. So there's been no relief on the inflation front for Main Street. And meanwhile, Wall Street and the Fed look at the drop in the CPI from 9 to 3 and declare victory and imagine that now it's time to provide relief from all of this, oppressive higher interest rates. So to me, the valve for all of the sins will be the dollar. And again, I've just articulated the cyclical side of that back on the heels of this Fed shift to easing after tightening. But that you're layering that on top of a secular backdrop for the dollar that's been very bearish for a long time, but particularly so after COVID, when you have these, and after the weaponization of dollar reserves with the sanctioning of Russia after their invasion of the Ukraine, that really was a line in the sand. And you've seen a lot of countries accelerate the diversification away from the dollar, and the BRICS plus nations coming together more meaningfully in terms of cobbling together trade agreements in local currencies and trying to find avenues around the dollar. And I think that this shift in the Fed will greatly accelerate those efforts. And so I think that the trade for 2024, or at least the only trade about which I feel confident, is that you're going to see the dollar much lower. And obviously, the mirror image of that would be gold and other precious metals. So that's the one thing where I feel like, okay, I can sit in 5% cash. I can have my gold. I can own some long dated treasuries. And just watch and see how this all plays out. And if the Fed really does pursue an immaculate rate cut, but if they don't, that secular story of the de-dollarization is still going on. And this is, going farther down the field maybe than you want to on this. But this year's BRICS summit meeting is being held in Russia. Last year it was in South Africa. And because of Putin being a war criminal, he wasn't able to go to South Africa lest he be extradited. So he couldn't be in attendance. Obviously, he can be in attendance at the summit this year in Russia in October, and it would make for the perfect time and location for he and Xi and the other BRICS nations to announce some kind of progress on a joint currency. So I just think that's a probability. But even if that doesn't happen, you're certain to see an acceleration in this de-dollarization, thanks to the Fed's pivot here.
Okay. And sorry, do you see the announcement that you were talking about as a probability, or do you see it as a possibility, like a wild card? They're probably working on something and at some point they'll announce it. Or do you think, hey, odds are really good it's going to be announced this summer?
I think odds are good. I don't know that I'd say I'm 100% expecting them to do it, but A lot of us expected them to do it in South Africa, and we're disappointed that they didn't come together with a statement then. But it does seem to me reasonable that Putin would have wanted to be in attendance and be one of the primary authors, let's say, of this announcement. So it's a perfect photo op. But when you look at what's happening behind the scenes in terms of the shift away from our treasury market and these moves to cobble together trade deals in
Lots
local
of trade deals
currencies.
that are not in dollars. Yeah.
Yeah, it's every day there's an announcement. And obviously Russia has already completely sold its treasury stockpile. It holds zero treasuries anymore. So it's not even like it's not buying as many. It's completely liquidated its treasury holdings and been working. I think they and China trade almost exclusively in local currencies now. They're not using the dollar for trade. So it's almost, the announcement will be more symbolic than anything else, but it'll be important symbolism for the West. I mean, I think everyone in the BRICS nations understands that this is happening and they're serious about it. It's, the policymakers in the West, the Fed, Congress, the administration, who seem to have their blinders on and imagine that there is no challenge to U.S. hegemony, and they can therefore pursue these wanton monetary and fiscal policies forever, and there'll be no repercussion to that. And I think this year might change that complacency a little bit.
Okay. So since you asked gold, you mentioned gold, I just got to ask you, it sounds like you think it's going to perform well, period, for the reasons you talked about, the sort of standard dollar down, gold up
Right.
reasons. Obviously, if there's a new BRICS currency that is denominated in gold grams, which is sort of what the rumor is, that probably be quite gold positive as well. Technically, if you look at gold, it's back trading very close to all-time highs now. And people debate whether this is a real technical pattern or not, but you have this sort of like decadal cup and handle that's been building with a triple top on the handle, and we're now back up at that breakout point. I'm assuming you think this could be a real breakout year for gold for a number of the reasons you mentioned, and maybe a few others, but are you expecting it to be like a big year, right, where gold breaks through its price ceiling and then maybe runs by a couple $100 an ounce?
Yeah, I mean, I think it will be a big year. I think gold will have, if you go back and look at past easing cycles, if we assume that the Fed is now embarking on a full-fledged easing cycle, gold should go up dramatically. Could it be 3,000 by the end of the year? I wouldn't be surprised. Now, that's aggressive relative to what most people who are bullish on gold are looking for. But to me, that's kind of a slam dunk. I do silly things like I look at how much, what would be the price on gold at which we fully backed the monetary base in the United States. If you went and
Those
looked at
numbers are
that,
silly, but yeah.
it's right. It's 10 times the current level. So we're 21,000 just to back the monetary base. Now, that's just an intellectual exercise, but it illustrates how how feeble our gold reserve is relative to the amount of money that we've printed over these last several decades.
Yep.
And compared to a lot of countries around the world, even though we have the largest gold reserve next to Europe, relative to the amount of money we printed, it's a drop in the bucket. And then you've got countries like Russia, where the amount of gold that they hold, albeit much smaller than ours, covers 50% of their monetary base. So, there's really no comparison. If they ever did challenge the US and say, look, we're going to back our currency with gold, what are you going to do? We'd really be hard pressed to compete with that. So I think gold, there are a lot of reasons to imagine that gold could go substantially higher in price. And that's before contemplating the prospect that we actually do have the credit bust that I've been forecasting
Mhm.
forever. And the Fed not only has to undertake a typical easing cycle, but has to be far more aggressive and then stop and eventually reverse QT and start re-expanding its balance sheet. And you and I have talked at length about, if we had a massive credit bust and a financial deflation, the amount of money that would have to be printed to backstop the public pension system, which is in the multiple trillions. So if you tack that onto the Fed's balance sheet, we're looking at a 12, $15 trillion balance sheet before all is said and done. So that's not going to be bullish for the dollar either, but it should be tremendously bullish for gold. So I see a lot of upside for gold. And as yet, it's not like anyone's actively in there. You don't talk to a lot of retail or hedge fund investors who are out there saying, "Hey, this is I'm all in on gold." It's still relatively, let's say, unpopular on Wall Street, although it's becoming more popular on Main Street. I'm sure you've seen the articles about Costco and Walmart
Yeah.
selling gold, and I know Costco, for one, couldn't keep inventory of it. So there seems to be some growing interest in it. We'll see.
All right, we'll see. I do have pensions on my list of questions. I'm going to guess we're not going to get to it just because I have so many other ones before we get there. But all right, so you talked about inflation. Let's dig into that just for a moment here,
Yeah.
because in previous conversations, when we were really looking at the debt overhang, we were looking at the maturity wave that was coming up for corporate America. We were expecting higher for longer, and you and I think, have been, respecters of the lag effect, right? And so we have expected that as we've moved through the timeline here, the lag effect would continue to become more and more of a visible issue. It hasn't been in many ways, and we've talked about some of the reasons why, liquidity being a big one, to the point where I think a lot of people are now dismissing it. Hey, the Fed's been able to finesse this, that we've just been able to make it's different this time. There's not going to be
Which
a lag
makes me even more confident that it's about to happen,
that it's about to, yeah.
Right.
So, but because of the belief in the lag effect, if I'm remembering correctly, you were saying, look, I think we're going to switch from worrying about inflation in 2023 to really worrying about deflation, eh, negative deflation in 2024. And you've talked a lot about how there's historical precedent in past cycles where we went from like 5% CPI to like -2% in the
Yes,
span of a
exactly.
quarter or two. So I'm curious if that's still your default expectation for 2024, or if you think, for a lot of the reasons we talked about, that's slowing that process down. And I'm just curious, do you have any concerns that if the Fed is pivoting too early here, right? It's basically going to embark on a more stimulative type policy when the economy is, quote unquote, doing just fine. Do we risk an Arthur Burns moment here where all of a sudden the inflationary spirits, resume here, and all of a sudden the Fed has to backtrack?
Yeah. Well, I'm glad you laid it out that way, because my deflation or disinflation thesis has always been a function of asset price deflation fueling goods and services price deflation. I never thought inflation in the economy would, suddenly decelerate absent a correction in the markets
Yeah.
and a reverse wealth effect that would be associated with that. So now that we're possibly taking that off the table by the Fed pumping money into the system before the crisis happens, it does change my outlook for inflation. Now, I'm not one of these who thinks we're headed into some hyperinflation or we're going back to 9%, but could we sit at 3% for a while and defy the Fed's expectation that inflation is going to quickly come down to its target? I think that's a very high possibility. especially when you lay on two things that I was just looking at. Well, one that we all know or are aware of, and that is that given what's happening in the Mideast, you've got shipping issues and you have the prospect again of supply chain disruption that will continue to put upward pressure on input costs, and to some extent feed through possibly to the CPI. But whatever that is, you're going to have more commodity and shipping and basic input price pressures. And then the second thing is we have actually seen, I wouldn't call it an inventory liquidation cycle, but a lot of the inventory overhang that had been persisting for quarter after quarter after quarter has been chipped away. And typically inventory cycles and inflation, not surprisingly, move together. So when you're building stockpiles, it puts upward pressure on inflation. And when you're reducing stockpiles, obviously it does the reverse. And we've come down sharply. I mean, inventories are now posting no growth, basically. We went from, a huge increase after COVID when they couldn't initially get any inventory, and then they overshot and over ordered, they double and triple ordered just so they'd have stuff, and then spent quarters, maybe even over a year, trying to unwind all of that. Well, they've largely unwound that. So inventories are in a pretty good position. I wouldn't say they're, conspicuously lean, but they're in a decent position where they don't necessarily have to worry about reducing them significantly farther. Now I think we're pretty even. So what my point is that the disinflationary pressure from drawing down that inventory has already been built into the numbers. So that drop from 9% in the CPI to 3% was in large part a function of that, or alongside of it. And therefore the impetus for further price deflation coming from the inventory thing is probably very limited, unless we see a sharp contraction in consumer spending, which for the reasons we just talked about may not happen if people can continue to just run up their credit cards and not pay them back to sustain whatever consumption they want.
So related to that, one of the things that has surprised me, and I'm guessing has surprised you in terms of just how things have been able to persist, is the labor market held in far better through this Fed tightening cycle than most people expected. And to me, that is if not the key, one of the most key dominoes to be watching, because if that can remain standing, then as long as consumer spending is going on, we're a 2/3 consumer spending economy, we'll probably muddle through okay. But if that falls, then it's game on for all the parade of horribles that we've been talking about forever. Right.
Yep.
And looking at the market, I mean, it's the jobs market. I mean, it is. I can definitely name some stats that are softening. The quits rates are down.
Yep.
Some of the payroll numbers they're not bad, but they're not great. But like continuing claims are coming down again, so like that's positive. It just doesn't seem like the job market is flashing super warning signals at this point in time. So while from a lag effect standpoint and all sorts of reasons, we could think it should have probably fallen by now, or we could think that there's risks for it to fall. It still looks a lot more robust than a lot would expect. So I'm just curious, what are your thoughts right now on employment?
Well, I think this is another manifestation of that expectations creating the reality that I talked about at the beginning. At the same time, expectations on the part of lenders that their borrowers would be able to pay them back as rates came down, enabled them to continue to shovel money at them, basically, and sustain these sort of feeble enterprises. Corporations acted the same way. So they basically operated on the assumption that you're going to see the Fed pivot and the economy is going to avert a hard landing. Therefore, why would I lay off all these people who I struggled so desperately to hire after COVID, when I know that this is just a short-term bump in the road. And then once the Fed cuts rates, we'll be back off to the races. So I'd rather suffer through this period holding more employment inventory, let's say,
Yep.
than I normally would like to have, just because I know that there's a light at the end of the tunnel. So if that assumption gets challenged, I think you could see a very dramatic and immediate reduction in employment. And that's what I've been waiting for a while, was that this realization that, hey, that I thought I actually believed the Fed when they said higher for longer. And so I
Yep.
thought, Wall Street spent all year going like this. No, we're
Right.
not listening to you. And they kept saying it and saying it and saying it. And then lo and behold, Powell caved. I don't know why I should be shocked, because it's not the first time he's done that, where he said, no, higher for longer. And then the next day decided he's, going to pivot. But so phooey on me for actually believing what he said. But, if they do actually do that, it will shape the employment picture dramatically, because they're sitting there with surplus labor inventory that they would shed, I would think, rapidly, if there was a perception that the landscape was not going to be, pivot immediately.
All right. So two things. One, just to level set, do you agree with me that that would be a game on moment in terms of, all the threats to the economy all of a sudden maybe get a chance to start coming in through the door?
You mean if employment were to turn, the employment market?
Yes. Yes.
Yeah.
If that, bet that the faith that the corporate fleet has right now, that look,
Yeah.
we're going to hold on to our human capital right now because this is going to be a transitory
Right.
period, and then we'll be back in salad days and we'll have the right people. If they start saying, oh wait, that's not going to happen, and they start shedding jobs, does that finally open the door to all those issues that we've been worried about?
It's hard to imagine it wouldn't. You would definitely think so. The other thing alongside it, though, would be corporate profits.
Right.
Whether one can lead the other. So
Right.
normally corporate profits, if they start to decline, will
Then
lead
you
to
lay
the
people
head
off.
count.
Right.
And
Yep.
we didn't see that last year. We actually had the profits recession without the labor recession. So maybe that will come as a down the road, when they realize, hey, we actually are going to go to a double dips profit recession. We're going to let go of these workers. But the other way around is you could have profit growth and this labor shedding that ultimately creates the profits recession, because suddenly your consumers are out of work and therefore they're not buying stuff. And then
Right. And if it leads that way, we might see profit growth initially, right? Oh, we've reduced our head count, so therefore our profits are higher, but
Right.
then the drop in consumer spending catches up, right? So the reason where I'm going with all this is, okay, so let's say the Fed actually delivers on what it is guiding the markets, right? We're going to do 3 rate cuts in 2024, right? You're bringing the federal funds rate, right, or the discount rate down from what, 5.25 to 4.5,
Right.
right? That's still pretty elevated,
Yeah.
right? So my point is like, can the Fed's rate cuts, can they ride to the rescue in time to rescue the corporate America fleet from all the maturity wall re-rating? Can it ride to the housing market's rescue in time? Right? Yeah, okay, maybe mortgage rates come down into the mid to higher 5s, right? This is still really expensive mortgages to what people were used to just 2 years prior, right? So like, are we throwing a party on somewhat false assumptions here?
Yeah. This is why I said, I think at the very top, that it depends on whether the Fed goes soon enough and aggressively enough. Because as you outlined, if you were a junk rated borrower borrowing at 4 and your rates went to 8 and now they're going to go to 6, you're still screwed. It's still a
Right.
massive increase in your debt service. And as I mentioned earlier, consumer debt relative to income is back to where it was in the global financial crisis. I mean, I remember just months ago, people pointing to that at low levels, saying, look, this increase in interest rates isn't an issue for the consumer because their debt service is still so low relative to income. And it's like, give it a minute. Where do you think all these rate hikes are going to be manifest? In the blink of an eye, it went parabolic, just like the Fed funds rate did. So I think that if the Fed definitely has to move with alacrity and aggressively if it's going to stave off the corporate default cycle, which is already underway. But then again, you get into this kind of issue of the expectations feeding the reality, because, all right, let's say they don't cut in March, but if the markets believe, well, that just means they're definitely going to cut in April, it can sustain itself. I mean, the question is, how long can the market hope sustain the whole construct without actual rate hikes being delivered? And I don't know how long that can go. I would say, frankly, it surprised me that it's been able to hold up this
As long as
long.
it has, yeah.
And in the face of, as I mentioned, the highest bankruptcies since the Great Recession, other than COVID. And again, credit card delinquencies, subprime auto loan delinquencies, I think, are at the all-time record high. So there's a lot of bad news out there that the markets have completely ignored on the assumption that this pivot is coming, and they've ignored it for the better part of 12 months. And it was a good year generally, not just for stocks, but for credit. So, I guess I have no idea how long they can sustain this on hope. But I would say every day that the Fed doesn't deliver, and if it doesn't deliver aggressively, it could be catastrophic for the markets, just because they've now, their expectations are so far afield of the fundamentals. I mean, just getting back to what's actually going on in the economy. When you look at the data, I know you mentioned Wolf Richter felt like, it's hard to forecast a recession. When I look at the data, it's hard to believe that we're not already in a recession. When you look at things like the leading indicator down, what, 19
it depends on what you
months?
look at. Yeah, exactly.
Yeah.
Still a lot of
I mean,
leading indicators, the inverted yield curves. I mean, just all sorts of tried and
right.
true recession indicators.
GDI versus GDP, we've never seen a gap. Like, there's so many unprecedented data points. Like GDI, we've never seen it go negative when GDP was positive before, except when you were in recession. But even during recessions, it's never been this dramatically diverged ever in history. So, I mean, there are just so many indicators out there. Then you look at, as I mentioned, real retail sales have gone nowhere for over a year. That's never been the case unless you've been mired in not just a medium recession, a deep, meaningful recession like 90 or 2008. So there are a lot of indicators out there that suggest we should be deep in a recession right now. And if the markets are that far afield from the reality, if the Fed doesn't deliver and deliver soon, we could get a reckoning of, epic proportion. The other moving part in all this, though, that leaves me even more gun shy is it's an election year. And you just can't be too cynical about the amount of effort that will be brought to bear to make sure that what we're talking about does not happen. I have spoken to two people who are politically connected who were telling me over a month ago that the Biden administration, rhetoric notwithstanding, was pushing hard for energy producers to get out there and just drill, get as much production as you can.
To lower the price of oil.
Yeah. And you see it in the numbers. You see the production, domestic production, I think, is an all-time record. So yeah, they want oil prices lower. And then who knows what happens on the fiscal front. And then with the Fed suddenly doing a pivot. So it's a really uncertain year. And that's why I guess I feel, there's very little one can say with great certainty and confidence. And the one thing that I think I can say with confidence is that the dollar is going to pay the price for whatever policy sins we commit this year.
That's going to be the relief valve. That's the thing that's going to be sacrificed in order of continued stability. All right. Well, in beginning to wrap up here, Stephanie, and again, I could go on forever. And I know I'm going to get a ton of comments saying, Adam, why didn't you keep going?
No, I think they're going to be like, why didn't you stop half an hour ago?
Not at
Because
all. I can
keep
guarantee you that's
repeating
not going to
myself.
happen.
Uh,
Um, are there any indicators that you follow closely that we haven't talked about yet that you think are going to be important ones to watch this year?
oh, wow. That's a good question. Um, yeah, well, I'm going to be watching that Baltic Freight Index for the shipping, what's
Because of
happening
what's
with,
going on in the Red Sea?
yeah, in shipping rates in general, because I think that's going to be important and obviously drives a lot of the input inflation side. Um, and I'll be looking at things like the Indeed weekly job postings to see what's going on that front. I mean, we've definitely seen a slowdown in hiring in general in the payroll numbers, and in like the Indeed measure is definitely rolled over. But I'd look to see if that starts to accelerate to the downside or not. And obviously. I'm going to be watching the consumer spending and really parsing out what of that is units versus price, and if we're seeing any kind of shifts there, and continue to keep an eye on the global movements in and out of the dollar. Those will be sort of my main focus this year. But and on the credit front, obviously, I've been watching all the corporate
Right.
downgrades. We had the largest number of downgrades last year since the global financial crisis, other than COVID. So, like I said, all the credit metrics are there flashing red, but when you look at the Bloomberg screen, they're
Right.
all flashing green. So
Well, and one key one that is not flashing red that I know you watch very closely are credit spreads.
that's what
And
I mean.
so, yeah,
The actual credit quality is flashing red, but the market measures of risk appetite are all flashing green. So credit spreads, yeah.
all right. Well, Stephanie, if on any of those key indicators throughout the year, you start seeing them move in ways that really catch your attention and influence your outlook of where things are headed, you just have an open invitation to come on this channel anytime and let folks know. Um, I'm gonna try to squeeze one or two more questions in before I wrap things up, if that's okay with you. Just because they're so interesting, and I really want to hear your thoughts on them. And of course, one is your market outlook. We haven't even gotten to the big question yet, which is just what do you think the markets are going to do this coming year? I know you think they're going to be pretty good for gold, but I'm curious any other assets. But before we get there, all right. So we talked about this sort of culture of moral hazard, right? There's a number of things I'd like to talk with you about in more depth that we're not going to be able to do here, but let me just sort of mention them briefly. One is that I sort of call this the transition from meritocracy to aristocracy, where I think we're getting to the point where it's legitimate to ask the question, is the American dream really only available these days to those who were born rich? Right, where there's this huge wealth divide. We are hollowing out basically the job system through cost-cutting measures like offshoring, but also automation and now AI, right? And it's getting increasingly we're removing those entry-level jobs, right? We've given companies all sorts of incentives for a very long time, as we've made it more and more expensive to employ human capital, but we've made it easier for them to replace that human capital, especially on the lower skill level, right? So the on-ramp for younger generations to build skills and create marketable skills, those rungs of the ladder are getting removed, right? So for this whole host of reasons, I think we're at risk of kind of building a bifurcated society here, where you have a very few doing very well and everybody else who's seeing their prospects as diminished, and probably increasingly entering jobs that are in service of that top elite, right? this is the discussion you and I could have for a long time, so it's unfair for me to ask you to opine too much on that in just a couple of minutes. But the question I wanted to kind of get to through those questions and a few others I won't mention here, which is, Stephanie, if I made you Empress of America, what reforms would you want to prioritize first?
Oh my gosh. Wow. That
Big
is,
question, I know.
yeah. Um, well, I think one thing that I would try to do immediately is just sweeping deregulation, because I think one of the things that stands in the way of a lot of uh, economic entrepreneurship and vitality and feeding that capitalist spirit is just the tremendous amount of bureaucracy that's imposed on people trying to get started in business. And the other side would be taxes along with it. I mean, I think to have lower corporate taxes and less regulation would help revitalize a little bit of that entrepreneurial spirit and give people greater opportunity there. And I don't know if there's a way that you could also incentivize trade schools, because one thing we're learning right now from for example, look at how tarnished Harvard has become.
Mhm.
And as you say, a lot of these jobs, people pay tons of money to go and get a degree at one of these schools, and then they're saddled with student debt, and they don't really have much job opportunity, because a lot of these jobs, as you said, are either already occupied, or they're going to be outsourced by AI or abroad or whatnot. Maybe somehow come up with some incentive or promotions for going to trade schools and sort of bringing that back. I know that that's generally frowned upon as being lesser than, but I don't think so. I think that that would help, restore a sense of pride in workmanship, etc.
Well, in a
Um,
sense of value creation in the economy versus a lot of the paper degrees that a lot of these, quote unquote, respectable colleges pump out. One of the
but
reasons why their
also
graduates
talking
have
about,
trouble finding help.
you talk about paper degrees. We've created a culture where our entire economy is basically there to create paper assets. A lot of it is just
Yeah.
we
Or not even paper. It's just to push digits from one side to the
yeah.
other.
I mean, we stopped creating things, and we've now gone into the production of paper and digits, as you say. And that's all very elegant and sophisticated. But I'm not sure, especially in the world of AI, that that's necessarily a sustainable economic model for us. And given the amount of debt that we've incurred in the process of doing that, I think maybe getting back to some simpler things might not be the worst thing in the world. And again, I don't know, but I would think that if you're building something that you can actually point to and provides some purpose, physical purpose, that might give you a sense of pride in yourself and in your country and in your job and, that kind of thing. I mean, it may sound a little um, hokey, but I think that that actually is a powerful thing that might be worth getting back to.
I don't at all. I don't know if you're familiar with the work that Mike Rowe does.
Yeah,
Um,
absolutely. I'm a
yeah,
huge
I'm a
fan. So
huge fan of his, huge fan of the
yeah.
Micro Foundation. Just for folks watching, I have reached out to his organization multiple times and been politely declined so far, but I will keep knocking on that door. He's definitely an interview I would love to land on this channel to talk about this exact topic, Stephanie. So, all right, look, will you get my vote for Empress then? Hey, real quick, just to make sure folks really fully understand, one of the reasons why you're pushing for less regulation and lower taxes is not because you're like, oh, I want companies to make all the money and overlord it over the populace. It is, I believe, you feel that we have sort of metastasized true capitalism, and it's now become this sort of uh, you know cartel capitalism, where it's actually pretty hard to find an industry that isn't dominated by a cartel of a small number of companies that have then written, worked with DC to write protective regulations around them, like a
Yeah.
regulatory moat that make it very hard for competitors to dislodge them, right? You're
Yeah.
nodding
I
as I'm
mean,
saying.
it's a much more articulate way of saying what I was
No,
trying
not
to say.
at all.
But
Yeah.
but in addition to what it does in terms of the structure of the corporate sector, it also has implications for the structure, geez, I can't even speak anymore, of Washington, D.C. We have all of these bureaucratic agencies that exist simply to regulate all of these industries and to sit there and ride their asses basically to make sure that they're living up to these regulations. I mean, we could cut out an enormous amount of fat there that's both encumbering our debt and deficit, but also encumbering our economy by strangling, potential entrepreneurs with this kind of unnecessary red tape. I mean, some of it, obviously, you need regulation, but we've jumped the shark on that. I think it's pretty clear.
Well, I think a good analogy is, love him or hate him. I think Elon Musk really shook a lot of corporate America, or at least big tech, to its core when he fired basically 75% of the staff of Twitter. And here we are a year later, and the company is still, it's still a going concern, right? He just really he redefined what an essential employee is, and he really shined a bright light on just the bloat and the fat that at least big tech has been guilty of accreting over time. I think very similar analogy to government, right? And we could probably get rid of 75% of the regulations, the laws, and the legislators, and just get down to the core ones that really matter. We probably wouldn't even notice it and probably run a lot better, right?
Yeah. Well, and get rid of all the lobbyists and, the whole structure that is so corrupt now.
Corrupt there.
And like you said, it really inures to the benefit of just a handful of major corporations and big industries that hold all the power. We need to get back to a real capitalistic system, which this is not.
I totally agree. I'll just mention this because it's interesting. I'll keep this really brief, but there was a great podcast that I think it was This American Life did, I don't know, 10 years ago or something like that. But it was trying to understand how lobbying works. And their investigation revealed it was the opposite of what you would expect, where we expect that in the halls of power in DC, the mild-mannered, unassuming politicians are walking around, and there are these lobbyists with big bags of money that pounce on them and try to influence their votes. It's totally the other way around. Yeah. It's the lobbyists that get hounded by the politicians who want their money, right? And when you really understand how much of a senator's day or representative's day is spent dialing for dollars versus legislating, it's ridiculous, right? So the whole system is definitely in need of a big enema, and well, that's a discussion.
Yes. I don't know if there is an enema big enough to
get there. All right. So I've thrown way too much in the mix here, but trying to end here on your market outlook. What type of year do you expect, given this kind of uncertainty and limbo status that we've been talking about?
Yeah, well, it's a really good question. I wish I had a crystal ball and I could tell you with certainty what I expected. So obviously the one thing that I did say I feel certain about is the dollar down and gold up. And I think treasuries will probably have a good year. But outside of that, the layup is volatility, I think we could expect much more volatility in the markets. Because for the reasons we talked about, it's not clear how soon the Fed is going to be able to move given the inflation backdrop, and then how aggressively they'll be able to move once they get started, and whether that'll be enough to support the markets. But I think the markets have a very clear expectation about what the Fed's going to do, and they have 100% certainty. And whenever the markets perceive something as being, they're going to cut here and then there and then there, there's a lot of room for disappointment, and that disappointment will certainly be manifest in increased volatility. So I think that would be just a no-brainer answer to that question. As to whether that means you end the year with lower stocks and wider credit spreads, that would be my best guess. But I'm certainly humble enough to say I really just can't forecast right now how this year is going to shape out. And again, the fact that it's an election year throws a giant wrench
Right.
into the whole analysis.
All right. Well, as I said earlier, Stephanie, you are welcome to come on the program anytime to update us as the tape changes in ways that catch your attention. Just a note too that volatility. I just interviewed Jim Carson, and volatility is something that he specializes in, and like you, he sees it playing a much bigger role in 2024 than it has in the past 2 years, particularly because it's been so compressed by forces that he and I discussed in that interview. And folks, I'll tell you in a second how to listen to that interview if you maybe want to listen to it after this one. So as we wrap,
one last thing that kind of plays into that increased volatility that we didn't talk about at all, and I'll just throw it out there, is the Bank of Japan and what they do this year. We're also focused on the Fed, but the Bank of Japan, if they actually do start to undertake a tightening cycle, would be a tectonic shift in the global financial plates that would have repercussions here. So that's just another one to keep an eye on.
Oh my goodness. All right. Let's flag that as one to get into the next time you come on
Right.
here.
No, it's way too much to talk about here.
Okay. But I appreciate you putting it on the board. All right. Well, look, as we wrap up here, I've got two questions I'm going to ask you here. The latter one, which is I'm going to ask you about in about a minute, is we've been talking all about money and financial investing through this interview. I've been asking my experts recently if there's any sort of non-money related investment that they would encourage people to consider adopting in their lives. So I'll ask you that in just a second. Much more important question, though, before I do, which is for people that have really enjoyed this conversation, Stephanie, and would like to follow you and your work from here, where should they go?
Well, they can go to macromavens.com and you can pull up some old reports there and see some media stuff and find some information on how to subscribe. Or you can follow me on Twitter, although I'm not a particularly religious tweeter. Can they say, or Xer? What's the term now?
I just stick with Twitter. I haven't moved on to the X brand yet.
Yeah. So I'm at S Pomboy there, except no substitutes. There are plenty of imposters out there. I don't know why anyone would try to impersonate anybody, much less me, but apparently they do. So at S Pomboy.
All right. Well, Stephanie, when I edit this, I will put up the links to your website and your Twitter handle right there on the screen so folks know exactly where to go. Folks, I'll have the links in the description below the video too. Two things on Twitter. One, just to Stephanie's point there about imposters. If you ever get contacted by somebody over social media, by Stephanie or by me, and they are trying to solicit you for anything, it's not us, it's scammers. And there is a scourge of scammers on social media. I really am hoping all the major social media platforms up-level their anti-scammer or spammer defenses this year, because it's just such a nightmare, as you know, Stephanie, having to explain to people, no, it's not me trying to sell you that crypto product, right?
Yeah, yes, it's definitely not me in that case.
Yeah. I'll also just make a quick comment here too, Stephanie, because I think I told you about this once, but I'm a very goal-oriented person, and so in trying to grow my Twitter audience, what I do is I achieve a milestone and I say, okay, great, who's somebody who has more people than me, and then let me try to work to get more than them. And I was kind of picking off all these different personalities on Twitter for the since I started my account. Well, about middle of last year, I started getting close to you. So you were the rabbit that I was chasing.
Oh my gosh. Right? Well, you've certainly passed me by now.
No. As of today, we have finally caught up to you, but it has been a 6-month painful journey. And because I got within like a couple hundred followers of you, and then our good friend Grant Williams said, hey, everybody, you really got to be following Stephanie. If you haven't followed her, you should go follow her. So overnight, you jumped by like several thousand more people ahead of me. So I was like, oh gosh, all right, well, I gotta work even harder now. And I got back up close to you. Well, and then you started going on Tucker Carlson, and you started jumping up after every appearance. So it has been a long slog trying to reel you in, but we were finally neck and neck here. And anyways,
well, congratulations.
Great competitor.
All I can say, Adam, is that I'd much prefer to be racing you on Twitter than on a sidewalk, because you would have blown by me 10 years ago for sure.
Well, until you brought us into a Pilates studio, and then I would have cracked in half, given how inflexible I am.
I doubt that.
But anyways, and just to make it clear for folks, what's been the most painful part about catching Stephanie on Twitter is that I work really hard at it, and she tweets only occasionally and only when she's got something important to say. And the fact that I probably put about 100 times more effort into it than you, and yet took me so long to catch up to you, just shows how much better
Well,
at this than you are.
no, I think it shows that I really need to put more effort into my Twitter.
Well,
Oh
if you
my
ever do,
God.
you're going to leave me in the dust.
No, I'm sure I won't.
All right. Well, a couple quick
Anyway,
housekeeping things before the last question. One, folks, if you've enjoyed this conversation with Stephanie and would like to let her know you'd love to have her come back on the program anytime she wants, please let her know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And just a reminder for folks too, that I on my Substack, which is still relatively new, I put out updates almost every day about the goings on here at Thoughtful Money. But I also have resumed my Adams notes, which are my Cliff Notes, detailed summaries, excuse me, of these interviews. So if you want to start getting those, including my notes to this interview with Stephanie, then go to my Substack and sign up for the premium version there. And my Substack's just at adamtaggart.substack.com. I also want to remind folks too that the Thoughtful Money is doing its first conference. That's going to be this March. And Stephanie has kindly agreed, as she has appeared in my past conferences, to be a participant this time around as well. She's always a fan favorite for reasons, folks, that should be abundantly clear here now at the end of this discussion. So Stephanie, just want to say thanks for being willing to appear in that.
looking forward to it.
All right. And then here we are now finally at the last question, which is, in addition to all the financial stuff we just talked about, what's a non-money related investment you encourage folks to consider?
Well, it's not an investment into a thing. It would be an investment of time. If I can use that as my investment, I feel like it's so important to invest in time with people that you get great soul satisfaction from being with, just taking time to be with friends. I have a friend that we walk our dogs together in the afternoons, and that, hour just strolling around with their dogs is just something I so look forward to. And that kind of thing just brings joy. And if you do that on a regular basis and you make time for those kind of things, it's what matters in life. I feel like, all the rest of this stuff is intellectually stimulating and hopefully financially rewarding if you can get it right, but nothing fills your soul and is as healthy, I think, as spending time with people you really love and making sure that you commit the time to do that.
All right, very well said. I've talked a fair amount in this program about kind of the supremacy of relationships, really, when it comes to wealth, because that's, I've said probably now ad nauseum, when they interview people who live to be 100, that's the number one thing they always say is the quality of their relationships. It's because we're social creatures, right? We're tribal social animals. So I won't pile on to the comments I've made in the past on this. I do want to pile on to one part of what you said, Stephanie, which is you went for a walk, you go for a walk with your dogs. Time with the people you care about, super important. Time with dogs is really important. And I don't know if you read the book Sapiens that came out a couple of years ago,
No.
Stephanie. It's a New York Times bestseller. It basically is a chronicling of the human species from literally when Homo sapiens evolved from the other proto forms of man, and follows them through like prehistoric times, then the agricultural age, and then the technology age. But one of the things I took away from the book was the first animal to be domesticated by humans was dogs, which kind of surprised me because I figured it would have been something that we could have eaten, right? Like a chicken or a cat or sheep or whatever, right? But it was dogs, and it was because dogs were attracted to our garbage piles, and they were scavenging from there, and we ended up creating a relationship with them. But the other thing that's really interesting is the gap between when we domesticated the dog, between when we domesticated the next animal. And I am doing this from memory, so it's probably not exact, but I think it was like maybe 20,000 years ago we domesticated the dog. It wasn't until it was like another 10,000 or more years before we domesticated the second animal. And then we started domesticating a bunch, right? But the point is dogs have been in the human experience longer than any other animal, to the point where I think we have kind of co-evolved together. And so just the emotional
Yeah.
fulfillment you get from that human dog relationship, I do think is different than any other animal. And I'm not slamming on you if you like your cat or your goldfish or your parrot or
Right.
whatever, but there really is something special about dogs and humans.
I think that's so true. I guess it's an ancestral kinship, it sounds like, but you don't have to persuade me. I could have gone on for hours about the importance of spending time with your dog, but people already know I'm obsessed with my dog. So I don't,
Well, Wilhelmina is a celebrity in herself.
oh my gosh. The one thing I would say though, in addition to it being important to invest the time with people that you enjoy spending time with and you love and spending the time with your dogs, it's equally important to disinvest from people who don't fill your soul,
Yes.
who don't bring positivity into your life. I think that's just as important as finding people who do, because if you surround yourself with people who are negative and bring you down, it's impossible to avoid being, impacted by that. So I don't know, maybe that's something that comes with getting older, where you feel like it's okay to have less friends who are really good friends, and not to have, 30 people, 20 of whom you don't really enjoy
Right.
spending time with them.
Superficial
Yeah.
or exactly, yeah, they're not adding to you.
Yeah.
So my wife is a therapist, as you know, Stephanie, and there is a theory. I can't remember exactly what it's called, but essentially it's sort of like you are the average of the 5 people that you spend the most time with.
Huh.
So it's all about trying to really be selective and picking the people whom
Yeah.
you spend the majority of your time with, to make sure that they are always pulling you up
Yeah.
to the group average, right?
Yep.
Um,
I'm blessed in that regard. So I'm a happy girl.
Thanks. Well, it sounds like you're choosing well, right? And
Yeah.
of course, you're somebody who, I think a lot of people would love to have in their 5 circles, because I think you're
Oh,
somebody
well,
that pulls
that's
people
sweet.
up.
I don't know.
No, very
Hopefully.
true.
Um, but anyway, well, thank you so much, Adam. It's a pleasure to get to spend this time with you always. And I hope I made some sense, although I'm incredibly, as you can tell, um, confused and befuddled about where we're going this year. So I'm just trying my best to put the pieces together.
Well, Steph, it's always a pleasure, and I appreciate you being so transparent, because I think a lot of people are seeing themselves in you here by saying, look, I'm confused by a lot of things that are going on here. A lot of stuff's happening that I didn't expect, or I see the data going one way, but reality going another. So I appreciate your generosity and courage to say, hey, there's some things here that I'm scratching my head about.
Yeah.
All right, Steph, it's always, I don't think I'm going to insult anybody by saying this, that you're always my favorite person to interview here.
Oh, well, I
Thank you
don't
for
believe
giving us
that,
so
but
much
thank
time.
you.
No, looking forward to lots of great discussions with you in 2024. Stephanie, thanks so much.
Thank you, Adam.
All right. Well, now's the time on the program where we bring in the lead partners from New Harbor Financial, one of the financial advisory firms endorsed by Thoughtful Money. I'm joined as usual by lead partners John Lodra and Mike Preston. Mike was off last week. So Mike, now that you're back, why don't we start with you? Anything you want to respond to from this pretty, as usual, phenomenal discussion with Stephanie?
I love the discussion with Stephanie, Adam. Thanks so much. And essentially, she was humbled. She started off by saying that she was humbled. I mean, my goodness, the S&P 500 was up 24%, roughly, in 2023. Who would have expected that? She talked about bank failures, that happened early in the year. We saw a continuation of the bond market collapse and rising yields. The 10-year yield touched 5%. And so, a lot of things were going on. And the fundamentals continue to be very negative. We have valuations that continue to remain in the stratosphere. It's like this permanently high plateau that just won't ever be allowed to correct. And I know there's some disagreement about what fundamentals to use, but we've looked at a whole bunch of different ones. And we think we're looking at the right ones. We think we're looking at valuation fundamentals that are highly correlated to what's likely to happen over the long term. The surprising thing is that the Fed and other central banks have created this money printing magic that's just lasted so long, 15 years, 15 long years of not knowing exactly what's what and what's real anymore, because we're so disconnected from fundamentals. But Stephanie said that she's been humbled. Well, I can tell you we've been humbled too. And we don't look at just calendar years. We've been humbled the last several years at just how long this has gone on. but she talks about expectations have been really high. Expectations have been really high for a Fed pivot, soft landing, that type of thing. And when Chairman Powell a couple months ago talked about potentially easing and maybe 3 rate cuts in 2024, the market took off, and it's been in a pretty straight line. And perhaps we'll share some charts later that show why we became concerned about another trip to the highs a couple months ago, and we took some actions to prepare for that. Now we sit just short of all-time highs on the S&P. It's likely that we make new highs, even with these bad fundamentals. We don't know. But we'll talk a little more about the details there a little bit later. But when you asked Stephanie, how do you react to all of this? She basically said, cash on the sidelines is how I react to this. That's pretty much what we think as well, although we're not 100% in cash. Obviously, we're over 40% in treasury bills still, and some of the pieces that we have in our puzzle or in our model have been working quite well, which gave us positive performance last year, where gold is testing its all-time high. Gold mining stocks are lagging, but we think that's going to change. And some of the specific sectors that we have picked have been working out. So Stephanie says she believes this year we'll see the dollar go higher over the year and gold go higher. I think
Actually, just to correct, she thinks the dollar is going to go lower over the year.
Thank you for correcting me, Adam. I was just going to say that we disagree on the dollar, and I had that reversed. She thinks the dollar will go lower on the year and gold higher. We actually think the dollar will go higher and gold will go higher. I would say that ours is more a short-term call. I think that we agree with Stephanie over the long term, the dollar will likely be lower, but we think that's probably maybe even 2 years out, 1 to 2 years out. In the near term, particularly if we see the kind of economic crisis or collapse in the stock market that we expect could happen even this year, the dollar is likely to go higher in the very short term. And thus we have a long position in the dollar. And of course, we're big bulls in gold. So towards the end of the conversation, she talked a little bit about the BRICS summit. I learned from her that the BRICS summit this summer is in Russia. Last year it was in South Africa. Maybe the fact that it's in Russia will mean that bigger news will be released about a potential competitor to the dollar. I don't know. I view a potential BRICS currency as a long-term negative for the US dollar, not necessarily a short one. As she pointed out, Russia and China are already trading with each other in alternate currencies outside of the United States dollar. So lastly, she said that there's going to be a lot of volatility. If she's sure about one thing, there's going to be a lot of volatility, that we're in no man's land here, and that she called it a cop-out that she's sitting in cash. I don't think it's a cop-out at all. I think it's a sign of humility that cash is paying 5%, at least for now. And valuations are stretched beyond all imagination. And whether we go higher into another bubble and collapse or collapse from here, we know from fundamentals this market will be a lot lower at some point. So, I'm really impressed with her directness and humility in that, and overall a very enjoyable conversation.
All right. A very enjoyable conversation. It's just an understatement when you talk to Stephanie. It's because it's just such a pleasure. John, why don't we let you chime in on anything you want to add to what Mike said there? And Mike talked about how your strategies resulted in a positive return for you guys last year. If you could talk a little bit about how New Harbor performed in 2023.
Yeah, great to be with you again, Adam, and hello everybody in this new year. Thank you for tuning in. As I said last week with our chat, my chat with you, Adam, we too were humbled, and we were probably very much in the camp, like many folks were a year ago, calling for a pretty high likelihood of recession. Interestingly, you look now, that same survey has almost nobody calling for a recession. So if you want to talk about contrarian data points, we're not going to go out on a limb here and say, hey, recession, yes or no. In fact, we don't even think that's the right question to ask. But that very data might be an interesting contrarian signal. But yeah, we did have a successfully positive last year. We're not the kind of folks that take victory laps, certainly not on a single year, because our clients don't retire for 1 year. They retire for 20, 30, 40 years, hopefully. And I think as much as last year being a amazingly strong market on the headlines, I think it's really important to remind what last year was in follow-up to a very poor 2022. And maybe by way of sharing that, I'll just share a chart of the S&P 500 to kind of pull that into context. If you can enable screen sharing, Adam. But in many ways, last year was basically digging out of losses of 2022. And in fact, maybe no better poster child than Kathy Wood's ARK Innovation ETF. That was up about 60 some odd percent last year, but it was down about 60% the year before, 2022. Now, most folks would be tempted to say negative 60% followed by a positive 60%. Wow, we're back to even. But that's not how compounding returns work. In fact, even after that 60-ish% return last year, the ARK fund is still down about 40%, give or take, over that 2-year period. That's how unkind suffering large drawdowns is. So let me share a screen of the S&P 500 just to kind of put things in context. So this is a daily chart going back a few years of the S&P. Here's the prior high, January 3rd of 2022. The closing high was 47.96. We were 3 points away from that last week during the holiday week between Christmas and New Year's. We've since turned down pretty sharply here in the short term. So you basically see the market went on a long, very interesting and scary trip to nowhere over the last couple of years. Last year, just focusing on 2023, and I'm going to speak in generalities. This is not a statement about every one of our clients, but on average, our typical client who's in our flagship portfolio had positive returns of about between 5 and 6% net of our fees. If not for our fees, they would have been up a little higher, of course. And just as important as we're happy that they had some positive returns, the volatility was far less in our approach by design, the way we hedge and the way we're keeping lots of dry powder. I estimate, for example, even a 60-40 portfolio, typical portfolio that most folks might get from a traditional firm, in the July through October drawdown last year was probably about a 9% drawdown. Our clients saw maybe a 3 to 3.5, maybe 4% drawdown at the same time. So over the last couple of years, our clients are up about 3%, 3.5% net of fees, whereas even a 60-40 portfolio was down about 1% or so over the last couple of years. So we're not going to take any victory laps, certainly not in any single year, but we're happy that despite a very challenging and perplexing couple of years, our approach so far has done quite well. And but we're looking forward. It doesn't matter the past; it's all about forward from here. While I'm on this chart, the S&P, I did want to point out we did just recently. We do have some. We're about 40%, give or take, in equities right now, much of which we have hedged, and about 15% or nearly half of that we have hedged in put options on the S&P. We took the opportunity with the recent strength to move those put options up so that they have a strike price of 5,500 on the S&P. So that's about a 4% below current levels. So the way to think about that is those hedges have about a 4% insurance deductible, if you will, before they kick in. But beyond that, if we do get some follow through to the downside, we're very comfortable that the hedges we have will stem some of that downside. Make no mistake about it, a lot of our short-term indicators are favorable. I hesitate to call them bullish because bullish portrays, hey, there's nothing but higher prices ahead. They're favorable, but there's also some things that are unfavorable. Very stretched, very overbought in the near term. Things like the percent of stocks above in the S&P above their 50-day moving average. It's like over 90%. It rarely does it get there, and when it does, it's a mixed bag in terms of follow-through returns. But we're positioned the way we think we should be, given the stew of things on the table.
John, let me just say one thing quickly, Adam. I think you misspoke by accident. You said the strike price was 5,500. It's 4,500, just for the viewers. It's easy to do, but the line is correct at 4,500. We are hedged out to March in the up at 4,500 with our current puts.
All right. Thanks for mentioning that, Mike. That was actually here in my notes. So
and I'll also add our bullish position in the dollar, it's through long call options. So effectively what that is it's being long the dollar, but it has a put option basically built in to that trade, so that if the dollar does weaken significantly, we're basically hedged on the downside.
Yeah. And so I appreciate you walking through that, John. to underscore a couple of things. One is your guys' approach there at New Harbor. One of the adjectives I use most often when I describe your firm and your services is risk management. That you guys are really always sort of first and foremost saying, okay, all right, how do we start from a position where we're really minimizing the potential for loss? And then when we feel good about that, how do we get some prudent gain on top of that, right? So for people, especially people who are later in life, like you said, John, people don't retire for a year, hopefully they retire for decades. You're being, as conscientiously conservative, with preserving their capital as you can be. And Stephanie, as she looked into the coming year, right, she said, look, I don't, there's a lot I don't know. And therefore, I think volatility is going to be a big part of, what happens in 2024, right? So it's strategies like the kind that you guys employ are ones that are basically adding defensive shielding around portfolios when it comes to volatility, right? So that if you're caught off sides by the trades you've made, right? You guys have put the type of insurance in place that is, not going to completely remove downside risk, but it's going to hopefully heavily mitigate it, in those areas where you've got that insurance protection in place. You're nodding as I'm saying this, John.
Yeah, that's spot on, Adam. That's the way we see it.
All right. So anyways, just want to underscore if Stephanie sounded compelling to you, finding defensive risk management strategies that help defend against volatility, good way to go. All right, boys, just in wrapping up here, got to keep this section short this week simply because we went so long with Stephanie, which is always such a good thing. Mike, maybe I'll let you wrap up here by talking about anything else you want to, but specifically that maybe you want to talk about gold for a second. You normally give us an update on it, but obviously given Stephanie's comments on it and the fact that we are still kind of dancing near all-time highs for the precious metal, how are the charts looking to you right now?
The charts in gold are still sitting right there. You're trying to break convincingly that triple top. I don't know if I have to share the chart, but it's been a long and slow winding sideways base. And it's just frustratingly just below that ceiling. Spot gold is holding above 2,000. It really has to break through 2,100 or so and stay there for a couple of days. I think that will spark the move higher. And I think it would hit 2,500 pretty quickly based on the charts. That's what the measured move higher would be based on the consolidation that we've seen in the charts. Stephanie says that she could see gold 3,000 by the end of the year. There's no telling what the high would be once you get a big base breakout like that. But, the fundamentals are certainly there and the technicals are there. What we're still seeing frustratingly with gold near its all-time highs is a continued underperformance in gold mining stocks. There's long periods of time historically where gold mining stocks underperform and or outperform the spot gold price. We happen to be living through a period here for the last almost 10 years now of underperformance. And whether or not there's good reasons for that underperformance, and I'm sure that I could list some of those reasons or speculate on some of those reasons, it doesn't really matter. The cycles kind of come and go like sine waves. Outperformance, underperformance, back and forth, back and forth. And if gold catches a bid and institutions start piling in, gold stocks will come up too. And then they'll move from underperformance to, at par performance, and then hopefully eventually to outperformance. So we'll see what happens there. But gold moving to 2,500 or so should be a big boost to gold mining stocks if that indeed happens. That's what it looks like for us. Silver has even more potential. So the last thing I would say in wrapping up, just reflecting on some conversations I've had recently, is we don't know exactly what's going to happen yet. No money manager does. We have very strong beliefs about the fundamentals and about history and about cycles. We feel very strongly that we're in a fourth turning, that the next few years are going to surprise all of us in what we might see in this world. And that what we see in the world, the real world, is certainly going to be felt in the financial markets too. And I think one of the big reasons that people hire a firm like ours is because we have a viewpoint that is at least somewhat in alignment with theirs. And the people that hire us say, we want you to take care of this. We want to delegate this to you. And not just for today, because we're trying to make money today, believe me. But what we're really trying to do as well is not lose. We have to allow for a little bit of wiggle room on the downside, but we want to not lose on the way down when we know that this will eventually happen. We'd like to make money on the downside if we can. It's very difficult in recent years, but we'd like to if we can. But at a minimum, we don't want to lose on the downside. And we'd like to layer into the market and get people's money deployed at a level where they can actually enjoy an 8 to 10 to 12% return for the rest of their lives. There's almost no asset that I can think of that offers those types of returns. Maybe gold does over the balance of, the next decade or two, but certainly stocks don't. Stocks are priced to achieve negative returns in the next 10
And just to be
20
super
years.
clear, you're saying stocks don't at today's current valuation.
At today's price. At today's price. And if there's some charts that, I've read, Hussman put out a piece the other day updating a lot of his charts. They're great. I'll save time by not bringing them up on the screen. But John Hussman's charts show minus 4% over the next 10 or 12 years is what we can expect. GMO in Boston puts out some similar stuff. A lot of other people have models that are respectable, that we respect. Valuations are out of this world. We're living through a very different time these last 10 to 15 years. So a passive model or passive basket of stocks today will achieve negative returns. And so with T-bills yielding 5% or more, it's no surprise that, Steph said she's waiting in cash, waiting for better prices. But that wait has literally driven people mad for over 10 years now. So that's why people hire us, to basically delegate all that worry and to know that they can trust that we're not going to fall prey to that emotional pull that's so hard. And so we don't know what the path is going to be. We're going to do our best, and we're going to make little mistakes along the way. But overall, we hope to get it right and to protect the downside and to place our clients' money where that they can actually get a return over the rest of their lives.
All right. Well, thanks, Mike. I want to thank both of you guys. I mean, one for coming on the channel regularly like you always do. But again, just to remind folks that one of the main reasons why I do that is to have you guys model for viewers of what a good professional financial advisor, how they think, the steps they take in response to changing developments on a week-to-week basis, the rationales they come up for why they're placing the trades they do, or coming up with the portfolio strategies they do. So thanks for being so transparent in all this, folks. And again, my general advice to viewers here is the vast majority of people don't have the bandwidth, the time, the desire, the experience to manage their money in this highly uncertain, highly volatile environment in which we find ourselves, as well as a good financial advisor who understands all the issues that we've talked about here and that I talked about with Stephanie. And so, if people want to go find their way and talk to folks like you, great. But if whomever they talk to, at least they have your guys' example as an example of how a good professional does it. And then they can use that to determine who they want to, how they make their decisions in terms of who they ultimately work with. So thank you guys for, again, continuously making yourselves available to serve as that model. All right, guys, well, look, as we wrap up here, just a couple quick things. Folks, if you enjoyed this conversation with Stephanie, would like to see her come back on the channel again, please encourage her to do so by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. A reminder that I am back publishing my Adams notes, which are my Cliff Note deep dive summaries into all the interviews that I do. I'm publishing those on my Substack over at adamtaggart.substack.com. I put a lot of free content out there almost daily during the week about everything that's going on at Thoughtful Money. But if you want to get my Adams notes, including my Adams notes for this discussion with Stephanie, then subscribe to the premium service there and you'll get them that way. Let's see here, in wrapping up, John, Mike, I guess, guys, just want to say thanks so much. I'm really looking forward to the time where I can be, flashing on the screen where folks can go to sign up to get matched with a financial advisor like I used to do in the past. We are hopefully just a couple of weeks away from that. As you guys know, I've been cramming with every spare second I have when I'm not making videos or laid low by COVID or going to family funerals and all the crazy things that have been going on recently. Because I'm studying for that securities exam, which hopefully I will pass, and that will be the key thing that unlocks the final piece of the puzzle here for the full Thoughtful Money offering. So hopefully, guys, maybe in 2 weeks when you're on here, I'll have good news to share with everybody. But in the interim, guys, thanks so much for coming on the channel. Everybody else, thanks so much for watching. We'll see you next week.
Thank you, Adam. Really appreciate being here with you, and we'll see you next week.
Thank you, Adam, and Happy New Year to you and to everyone else, all your viewers. See you soon.